how you pay yourself from your LLC is one of the most strategic financial decisions you will make. If you get this wrong, you can easily pay tens of thousands more in taxes, lose your legal protection, and even put your business at serious risk. While it may sound simple, most people underestimate how complex this decision really is. Many LLC owners don't fully understand the different ways to pay themselves, how much they should take, or how these choices affect their taxes, especially with new tax rules coming in the near future. This guide walks you through the major steps you need to consider when paying yourself correctly from your LLC. Let's jump in. Okay, let's start with the owner's draw, also known as an owner's distribution. As the owner of an LLC, you have the right to draw funds from your LLC at any given time through an owner's draw or distribution. This is literally as simple as transferring funds from your business bank account to your personal bank account, either through a wire transfer, ACH transfer, or you can even write yourself a check or go to the bank and simply withdraw cash from your business bank account. To properly set this up, you would just need two things. First, an employer identification number for your LLC. This is like a social security number, but for your business. If you do not have this, you can easily apply for one for free through the IRS. Second, you should also have a business bank account for your LLC, which should be completely separate from your personal bank account for a number of different reasons. You have to remember why people set up LLCs in the first place: liability protection. In other words, if someone sues your business, your personal assets would be protected. But a lot of people don't realize that you can completely lose this protection if you commingle your personal funds with your business funds. There needs to be a clear line of separation between your personal and business assets. Secondly, keep in mind that the IRS does not like this either. They may question the legitimacy of your LLC tax deductions if they see personal expenses mixed in with your business records. So make sure you set up a separate bank account for your LLC to avoid potential issues later on. Once you have those two things, you can move on to properly executing an owner's draw or distribution from your business bank account to your personal account. For example, if your business made $5,000 last month and you transferred $2,000 of that from your business to your personal checking account, that $2,000 amount would be your owner's draw or distribution. It is extremely important to properly document these transactions and categorize them to establish a clean paper trail. Each time you take an owner's draw from your business, these payments should be classified as an owner distribution in your bookkeeping records. One of the biggest mistakes people make is categorizing these payments as wages, cost of labor, or some other type of expense. This is completely wrong and can cause multiple tax issues because owner distributions are not expenses in any way, shape, or form. Your LLC does not deduct owner distributions on its taxes. Another major question people have is how much they should actually take in owner distributions. Technically, how much you take out as an owner distribution is your choice, but there are important nuances to understand. How much you take out as an owner distribution is your choice, but there are some key nuances to understand here. We often see people make the mistake of taking too little out of their LLC or too much out. So let's walk through a few important things you need to understand. First, you are not taxed on your owner distributions, at least not directly. You are taxed on your LLC profits based on your ownership in that LLC. This means that even if you do not take any distributions at all and you leave all of the LLC funds sitting in your business bank account, you will still pay personal income tax on your LLC profits. In the eyes of the IRS, all of that income is yours, whether you take a distribution from your LLC or not. So if you are going to pay tax on the income anyway, it often makes sense to take those profits out as distributions. However, there is also the problem of taking too much out of your business. Here are two general best practices. First, try to reserve roughly a quarter to a little over a third of your business profits for taxes. Some business owners even set up separate savings accounts specifically for taxes to make sure enough money is set aside. You do not want to be in a situation where you make good money but cannot afford to pay your taxes. Second, it is typically a good idea to leave at least a few months of cash in your business to fund operating expenses. Some owners leave even more when they have significant reinvestment plans or high overhead. This way, one bad month will not prevent you from paying expenses or force your business to shut down. This happens more often than people think. Those are the basics, but as you earn more income through your LLC, you will owe more taxes. As your tax exposure increases, opportunities open up to optimize how you pay yourself in order to reduce taxes. When you earn income through an LLC, it's taxed as a pass-through entity. In other words, the LLC itself does not pay income tax when it files a return. Instead, all income earned through the LLC passes through to the owner's individual tax return where it is taxed. That income can be subject to several types of tax. There's federal income tax, state income tax, depending on where you live, and self-employment tax. The self-employment tax is what surprises most LLC owners when they file their taxes. The good news is that you can limit your self-employment tax by optimizing how you pay yourself from your LLC. Earlier, we said that aside from leaving money in the business for expenses and taxes, it often makes sense to take owner distributions since you are paying tax on the income anyway. While that is true, it is not the only way to pay yourself from an LLC. There is another method that can actually lower your taxes if done correctly, and that is taking W-2 wages from your LLC. Instead of paying self-employment tax on all of your business income, you can limit that tax to the amount you take as wages. For example, on $150,000 of self-employment income, the self-employment tax alone would be close to $23,000. But if only $50,000 were subject to that tax, the tax would be much lower, resulting in significant savings. This is possible only if your LLC is set up in a specific way. You would need to elect to have your LLC taxed as either an S corporation or a C corporation. For simplicity, we will focus on S corporations, which are more common. So when your LLC is taxed as an S corporation, none of the net profits are subject to the full self-employment tax. Instead, shareholders who work in the S corporation are required to pay themselves a reasonable salary in the form of W-2 wages. These wages are subject to payroll taxes like Social Security and Medicare, which are the same taxes that the self-employment tax funds. The difference, however, is that you can set your W-2 wage at a reasonable level instead of paying self-employment tax on all of your business income. This alone can save thousands of dollars in taxes. For example, in the earlier example, more than $15,000 in taxes were saved by paying a $50,000 W-2 salary, leaving $100,000 in profits that were not subject to employment or payroll taxes. In this case, the owner would take a $50,000 W-2 salary from the S corporation and still be able to take $100,000 of the remaining profits as owner distributions, which would not be subject to payroll taxes. Those profits would still be subject to federal and state individual income tax, but a large portion of employment taxes would be avoided. This leads to an important question. When does it actually make sense to have your LLC taxed as an S corporation? If you ask multiple professionals, you will likely get different answers. In general, it tends to become more beneficial once net income reaches roughly the mid-5-figure to low 6-figure range after deductions. This is because S corporations come with additional costs and responsibilities. These include filing a separate tax return, running payroll, submitting payroll taxes, and filing payroll tax returns. If the tax savings do not significantly exceed these additional costs, electing S corporation status can cause more harm than good. Even when an S corporation does make sense, you still need to carefully determine how much to pay yourself in W-2 wages. The more wages you take, the more payroll tax you will pay. But if you take too little, the tax authorities may step in, since the salary must be reasonable based on what someone would be paid in the open job market to perform the same work. There is one more major topic to discuss, and that is upcoming tax rule changes that may impact how LLC owners choose to pay themselves going forward. Let's start with the self-employment tax cap. This is the maximum amount of income subject to the full self-employment tax, specifically the Social Security portion. In the upcoming tax year, the cap is expected to be around $185,000. This means you would pay the full self-employment tax on income up to that level. That can result in tens of thousands of dollars in additional taxes before the rate changes. Once income exceeds that cap, a lower percentage tax applies to amounts above it, but this can still add up quickly for high-income earners. If you currently earn a large amount of active income through an LLC that is not taxed as an S corporation or a C corporation, it is important to be aware of these taxes so they do not come as a surprise later. The good news is that there is often still time to plan and make changes before those taxes hit. There are also new deductions and tax rules to consider. There are also important rules associated with recent tax legislation. These rules reintroduced 100% depreciation, a permanent 20% qualified business income deduction, and other business deductions. These deductions may allow you to take more expenses up front and report less income on your tax return. This matters because the less income you report on your LLC's taxes, the less self-employment tax you would owe. As a result, it may be less necessary to switch your entire entity over to an S corporation or a C corporation. For example, if you expect to report $100,000 in income through your LLC, someone might immediately assume that they need to be taxed as an S corporation. But if you are able to deduct $40,000 in equipment or property, contribute around $10,000 toward retirement, and receive a $10,000 qualified business income deduction, then your net income would drop to roughly $40,000. At that point, it becomes important to ask whether the cost of running an S corporation is actually worth the tax benefits being received. These are very nuanced questions, and it is extremely important to perform a thorough tax analysis with a qualified professional. The goal is not just to pay yourself directly, but to structure your income in the most tax-efficient way possible based on your specific situation. The right strategy depends on your income level, deductions, and long-term goals. Understanding how these rules work together can help you avoid unnecessary taxes and make smarter decisions for your business moving forward.